Hello and welcome to the Financial Bunny TV. My name, of course, is Nicolette Mashila and I am your Financial Bunny. Today, we're talking about diversifying your investment portfolio with Michael Field, who is General Manager of Investments at Fedgroup. Now, you know, as we always say, do remember that nothing we say on this channel constitutes as financial advice. If you are, however, looking for financial advice, please do speak to somebody who is certified and registered with the FSCA. And thank goodness that the guys at Fedgroup are indeed registered, right? Michael, welcome to the Financial Bunny TV.
Thanks so much.
Awesome. And I think for me, I want to get into, I've listened to you speak, of course, and I must tell you guys, Michael is very passionate about us not having this tunnel vision that we've got with equity, but we're going to get to that. I want to start off with what is investing?
Besides the obvious, let's take it back. It's giving your money to someone else, letting them create some value, and you're going to get back a bit more in the end. You could maybe say it's buying something with the expectation that it'll be worth more in the future. So if you think across your different types of investments, maybe property, you're going to buy a property and hope it becomes worth more, or that it's generating you more than it's costing you to upkeep. It's about using your money to create additional value, really.
Okay, then in that notion, let's take a classical car.
Yeah.
You buy a classical car. At the time you're probably buying, you don't know it's a classical car yet, right? Then you drive it. Now we talk about cars, we know depreciating asset, right? So immediately it's taken off it being an investment. Yeah. But then one day you wake up and all of a sudden this car is now worth more than what you bought it. Could we classify that as an investment?
You could.
Yeah.
It's, as with any investment, it's got different risk criteria. Cars tend to generally be not investments. As you said, you drive a car off the lot and you've lost 20%. Almost all cars just keep sliding.
Yes.
Unless you're buying sort of limited edition Ferraris and
True.
things like that.
Yes.
It's pretty rare that a car is going to turn into an investment.
Yes. I like that. I like that you said it's pretty rare that it could turn into investment. I think the part of turn into investment is quite important and key to me. And I think key to this conversation, because then we want to talk a little bit about what is diversifying when it comes to investing. So you've got these different things that you can invest in, but why shouldn't I just invest in one thing?
Ultimately, all investing has some inherent risk. Some investments are more risky, others are less risky, but there's always going to be risk there. And diversification is about saying, how do I diversify the effect on my investments because of some underlying risk?
Yes.
Now, what's key to diversification is making sure that your investments are not all linked to the same risk.
Okay.
You could say, I could maybe own one large property.
Yes.
Or I'm going to diversify and own lots of smaller properties. That's one type of diversification.
Yeah.
But if property is not doing well because there's too many properties, or interest rates are going up, it's becoming really expensive to service that bond, you haven't diversified away from that risk. So if you, rather than owning one large property, said, well, own a small property, and then I'll have some equities, and I'll have some fixed income, and maybe some alternative investments, have that spread that are linked to different things. So if property's not doing so well, that's only a portion of your portfolio.
Then
if interest rates are going up, maybe your property's quite expensive, but then your fixed income is going up. And so you can balance and try and de-risk your portfolio in that way.
And of course, you think from a financial perspective and you think in finance terms. I'm thinking in fruits, right? So I'm thinking you go to the fruit and veg and you're buying fruit based on what could potentially happen if the weather becomes very hot. So we know that the bananas will probably start to ripen very quickly. Apples will do the same thing, but apples may be okay. So that's kind of my diversifying. Instead of just buying bananas, I'm buying apples, bananas. Okay, all right. Makes a lot of sense. Let me tell you, it's important for me to think in that way, right? Let's talk a little bit. I think you've kind of alluded to some of the asset classes that are out there and are available. Let's talk about them. What are they? I think young people, when they think of investing, they want to invest. But sometimes it's very difficult to know what is actually out there that one can tangibly invest in.
Yeah.
Yeah.
The 5 sort of typical classes that people would talk about would be equities. It would be fixed income, bonds. It would be property, cash, and alternatives.
Okay.
So very quickly, so equities is shares on a company, normally on a stock exchange. So
Okay.
JSE, I'm going to buy shares in such and such company. Bonds is just debt. So lending money to someone who's going to pay you back. Very simply. Number 3 would be sort of property. I think that's quite self-explanatory. There's a couple of ways you can own the property, try and get some rental income, hope it becomes worth more, that sort of thing. Cash is basically, think of a money market investment, maybe some of your bank account type of products.
Yeah.
And then when we talk about alternatives, in many ways, it's everything else.
I was about to say alternative sounds like we're just going to put even my classical car falls under there.
so
Yes.
your classic car would be considered an alternative. Baseball cards is an alternative.
Pokemon cards, apparently.
Yeah, go crazy.
Yeah.
But those are some of the more out there things. You would then have elements like hedge funds. Those fall under alternatives. But it's really broad.
Yeah.
So the ones we've talked about, some of the more out there ones, some of the stuff that we at Fedgroup play in is sort of agricultural investments. All our solar, so you can invest in sort of rooftop solar. That's considered an alternative in terms of asset classes.
Yes. And when we're talking about the real picture of diversification, what would it look like? Because and going back to your example, so instead of buying one big property, you buy 5 smaller properties. However, whatever happens in the property market happens to your entire investment portfolio. And often we find that that's what is offered out there when it comes to diversification. They'll just give you different types of funds. But now when, things happen, you're feeling it across. So what would a real picture of diversification focus on for you?
Like I was saying, it's about looking at that risk. What's going to drive these investments? And by the way, it's not just the risks, it can be the upsides as well. And how do we have that spread? We talked about the property. If you consider equities, people don't buy just one stock.
Yes.
It's a similar concept. Then people might not invest only in South Africa. They might have some offshore investments. Again, it's having that full spread. So if you then add in some bonds, so some debt type of product. In our world, we use property-backed bonds. So, in other words, the guy that's investing in property is taking out some debt. We allow people to invest in that debt. Now, we talked earlier, when interest rates go up, your property is going to take some strain. Because your lending costs are high. But if you are lending money to that guy,
person,
it means your investment is going up.
Makes sense.
If you had some of each, you can balance out that risk. You can then take things like, I talked about our sort of agricultural, some of those assets, and our solar. So we've seen the price of electricity going up and up and up. If you invest in a business that is in manufacturing, they use a lot of electricity, their costs are going up, their profitability comes down. If you're selling that energy to them in the form of owning that solar panel that's generating that electricity, your profitability is going up. If we look at some of the agricultural stuff, it's food. In simple terms.
And everyone needs food.
Everyone needs food. We've all seen what's happened at the supermarket checkout. Food prices are going up. Many elements in the economy are struggling because of these real inflationary things that are making everything so expensive. If you are the one selling that food,
you're still winning.
So it's about looking at these different elements and making sure you've got that diversification. It's not just spreading across things that are all affected by that same underlying.
Well, I've kind of alluded to your gripe with the tunnel vision that exists with equity. Maybe take us through it.
Yeah. I talk about this tunnel vision. It's equities. Remember, this is our listed stocks that they're exciting. They can often deliver a lot of great returns, but they tend to be quite risky and people are obsessed with it. If you look at, even in the industry, many of the investment funds that have this diversification to an extent, it's all about the the equities. It's all they talk about. People think they are getting diversification by being in a couple of funds. But if you look at their fact sheets, all of the shares that they're invested in are all the same. And there's become this total obsession with equities. There is so much more out there that we need to be considering in our investment portfolios.
Well, speaking about that, what should young people be considering, in your opinion?
I think step one is they've decided to start.
Which is good.
That is the most important thing. I think keep it simple. If you don't understand it, don't go there.
Okay.
Make sure it's something you can understand, and be wary of providers that are not going to, keep it simple.
Yeah.
They're probably trying to pull a fast one on you. There's a couple of great starting places. Remember, what are you investing for?
Yeah.
Tax-free savings accounts. It's a really fantastic vehicle. Make sure you're getting a good solid return. If you're getting anything less than 6-7% in sort of today's market, no, you need to keep looking.
Okay.
So, at Fedgroup, it's a product we offer, something quite innovative, that's delivering 10.6 as at last month. That's a great place to start. Then look at a unit trust fund is a great place, depending what you've got to invest. So I'll talk from our point of view at Fedgroup. You can access some of our agricultural investments from 500 Rand total, and you're in and ready to play. Many of the funds out there, you're starting at 10,000, 20,000 minimums. Having said that, where you've got a bit more to invest, you can start climbing that ladder using the products that are better suited to you. Step one, start. Tax-free savings, great. A unit trust is probably a nice, good second step. Something interesting like some of what we're doing in the impact farming. Nice, tangible, easy way to get some of that diversification.
I like that. And then the last question that I've got for you, Michael, is I think I want to find out, some people do start, then they get lost along the way because maybe those principles are not necessarily, they haven't settled in yet. What would you say are the most important principles of investing?
For me, the single most important thing is make sure you understand what you're investing in. Investing need not be complicated. It isn't complicated. Many of the structures today can get quite complex. Chat to an advisor. I think that's another thing. Certainly, myself, Fedgroup in total, we really believe in advisors. And then learn. I mean, the fact that your listeners are watching something like this is fantastic. They're learning about investments. Start small, start simple. Be wary of picking your own equities stocks. So equities are fantastic. We run a lot of equity. I know I give them a hard time. We run billions for our clients. They're a fantastic asset class. Don't be obsessed. And as an individual, I would really recommend that you're very cautious of picking your own stocks. I think I mentioned previously on your podcast, this is what I do for a living. 2% of my personal portfolio is stocks that I pick for myself. Why? Because if you're investing on anything less than sort of a 10-year time frame on those stocks, it's a sort of I have to win and someone else has to lose. There's no leagues in the investing world. You are competing against a Ronaldo and a Messi. You are driving against Lewis Hamilton, Charles Leclerc. It's what I do for a living. I don't have the time, expertise to be picking my own stocks. So it's a lot of people get quite excited by that one.
All right, so I think we'll cap it there. Thank you very much, Michael. I think that was quite an insightful conversation.
Yeah, thanks so much.
Awesome. Guys, if you've had the opportunity or not yet, go and listen to that podcast. It is Yes, Money Does Matter by ourselves, Financial Fitness Bunny, where Michael actually goes into the value of advice. I think that's quite important, is understanding why you need that person to be able to look at your own portfolio, help you with your portfolio, and actually put together a solid portfolio that will speak to your needs and the goals that you're trying to achieve. One thing that he mentions quite a lot there is taking your emotions out of the equation. So it's a very interesting conversation. Do get to it, listen to it, and come back to this specific conversation and tell us what your thoughts are. But as we always say, thank you very much for tuning in, and I'll see you guys on the next one.